Hi, and welcome back to Let's Talk Forex with Alison and Chris. This week, we're talking about flexibility in Forex trading. With the Forex market being so unpredictable, flexibility is really important. And this week, we talk about how to build it into your trading strategy without taking unnecessary risks. As always, we'd love to hear from you. You can reach out to us at podcast@fxscouts.com and check us out on Twitter, YouTube, Facebook, and LinkedIn. Thanks so much and enjoy this week's episode.
Hey Chris, how are you doing?
Yeah, I'm okay, Alison. I'm pretty good. We're recording on a Friday for a change.
Yeah.
Which is nice. So a bit of the Friday feeling. Though the sun has disappeared and it's gotten cloudy.
Oh no.
I know. The whole week, wall-to-wall sunshine. Friday comes along and clouds roll in.
Oh no. So
very disappointing.
What is your forecast for the weekend?
It's actually supposed to rain tomorrow morning. But then after that, it's going to clear up. It's going to be, I think, 23, 24 and sunny in the afternoon. Yeah. So I think we'll probably head down to the beach.
Oh, fantastic. Yeah, we've got
taking a page out of your book.
Yeah, for a change, hey.
Yeah.
But our side, we've had quite windy weather for the last couple of weeks. Yeah, it's been extremely windy, but now it's sort of calmed down and the sun's out today and it's a beautiful day at the beach.
So, look at you.
Yeah.
So you're going to head down after work? You're going to go get down there?
Yeah, absolutely. Definitely head down.
Good for you. Good for you. Cool. What are we talking about today?
Well, today we decided we wanted to talk about flexibility in Forex trading and how traders can achieve it without basically taking any unnecessary risks, and just why it's so important to be a flexible Forex trader.
Yeah, exactly. It's flexibility is really essential for navigating the market because it's so unpredictable.
Yeah.
So if you've built flexibility into your trading strategy, you can respond to trading conditions, and you can get your orders correct, and you can make more informed decisions as well.
Yeah, exactly. And also because prices are influenced by many different factors, as we know, economic indicators or economic announcements, geopolitical events, market sentiment, and these are all changing rapidly. For example, we spoke about this a few weeks ago. At the beginning of the year, we saw that the Forex market experienced its lowest volatility in years. And
that's right.
This was mainly due to the Fed and ECB's stance on interest rates, where there was basically no movement for months. And at that stage, then Forex traders, they didn't know there was much lower trading activity that was happening on the Forex market. And if you're a full-time trader, you had to trade something. And if you were inflexible, then it was a very difficult time as a trader.
Yeah, and we saw a lot of traders moving into other assets, didn't we? They're moving into stocks, into commodities, crypto, all kinds of stuff just to get a little bit of volatility.
Yeah.
So yeah, it's really important. Because like we were saying, it allows you if you're flexible, you can shift, you can adjust to market trends. Really importantly, you can capitalize on emerging opportunities. And then when there is, the opposite, what we were just talking about, when there's really high volatility, it allows you to be able to protect your investments as well. Protect your capital. So yeah, really, so this ability to pivot and modify your approach really ensures resilience and responsiveness. And this is really what you need to navigate the Forex market. Well, all markets, the CFD markets in general. You want to be resilient and you want to be responsive.
Yeah, and there are quite a few strategies you can use to build flexibility in trading. And the first one is to diversify your trading strategy. So instead of solely relying on a single approach, you may want to look at incorporating various methods to adapt to these different market conditions. So, for example, if you combine trend-following strategies with range-bound strategies, then you could actually seize the opportunities that align with whatever the market dynamics are expressing at that time. But if you stuck on one type of strategy, then you're definitely not going to find the opportunities to trade.
Yeah, exactly. Like we were just talking about, the markets being of the year, they were very range bound.
Yeah.
And if you're only using a trend following strategy, I mean, you're out of luck.
Yeah.
Yeah. So it's really important to have a few different arrows in your quiver, as it were. Yeah. Another really important thing is using multiple time frame analysis. I think we've actually recorded a podcast on this entirely as a topic. Because daily charts, they'll offer you a really broad perspective, but short time frames, they highlight the details of price movements. So you often want to, zoom out, get the big picture, and then zoom in and look at the detail. And integrating this stuff from various time frames, it helps you understand the full picture of the market. You can see overarching trends. You can see, more short-term trends. You can see medium-term trends. And a lot of traders, a lot of beginners especially, make the mistake of only using analysis on short-term timeframes.
Yeah.
And that's a big no-no, because if you don't see the overarching trend, you can often get caught out, and you don't want to be trading against a long-term trend, even if it looks like there isn't a long-term trend on the short-term timeframes.
Yeah, and also just something we spoke about before is just drawing those trend lines. So make sure that you draw the trend lines from the overall long time frames, and combine them with the shorter time frames. It often gives you an idea of whether there's a channel forming, or whether the price might hit some sort of resistance that you wouldn't have seen on the shorter time frame. So it's very important to do a longer time frame analysis before you analyze the shorter time frames.
Yeah, and that doesn't mean you shouldn't trade against the trend in shorter time frames. It just means you need to be aware of them.
Yeah.
Yeah, it's really important. So using this multi-time frame analysis, it allows you to align whatever your strategy is with both the overarching trend, the longer term trend, as well as these short-term fluctuations that you're going to see.
And then the next one is to prepare for economic events. I know it's something we've spoken about just now, but economic indicators, central bank decisions, geopolitical developments like we've just seen in the Middle East, all influence the currency markets. So flexibility here means staying informed about the upcoming events and anticipating potential market reactions. So this means that you actually need to understand what the different news announcements mean and what it could potentially do to your currencies. But if you are a beginner and you're unfamiliar with how these events will affect your trades, if you're just learning about it, then our advice always is to close your trades when you know that there's a news announcement being released, and reopen them once the volatility has died down. So what you want to do is always be aware of the events on an economic calendar. And if you see that an event might affect the Forex pair you're trading, simply close the trade until that volatility has died down. It's probably
exactly
the best thing you can do if you don't know.
Yeah, if you don't know how it's going to affect. And to be honest, a lot of even seasoned traders get caught out by how news can affect fundamentals. It's a really difficult one. It's a really difficult one to stay abreast of.
As we've seen recently, Chris, I remember I think there was an ECB announcement, and we were discussing, what would happen to the euro dollar, and I can't remember. I was saying, well, why is it doing that when there's been this announcement? And you were saying, no, it's profit taking, and they stop hunting, so they're trying to stop everybody out before. Yeah, I remember having that conversation with you quite a while back, and so you can't predict the direction.
No. You'll often get after big economic announcements, we get stop hunting. It's something we discussed with Caroline, Trading Angel, a few episodes ago. How the big market movers will often after news announcements will go stop hunting, and then you'll see the market move in the way that you expected it to be.
Exactly.
But only after they've closed out, everybody stops. Yeah, naughty.
Yeah,
very naughty. So yes, the point is, if you're not sure how a news announcement is going to affect the market that you're trading, close out your trades, wait for everything to die down a bit, and then get back in again. The other important way of incorporating flexibility into your trading is you need to be able to adapt to market volatility. So markets, they can shift from, being low volatility, being very calm, to really turbulent, to really, really volatile very quickly. So this means you need to adjust your risk management strategy in order to use that volatility as an opportunity. You don't want to be caught out by it, but at the same time, when it does happen, you want to be able to take advantage of it. So this means being able to respond quickly to sudden market movements, identifying breakout opportunities, and then you need to optimize your trading approach as conditions evolve. The risk management here is really important.
Yeah, having stop losses in place really is important.
Mm-hmm.
And then next, you want to also understand currency correlations. I know it's something we've also covered quite recently in many podcasts, but different currencies move in relation to each other based on economic factors and global events. So if you understand currency correlations, then you can make informed decisions and manage your risk. So certain currency pairs tend to move in tandem, or they can move in opposite directions. But this allows you to also diversify your portfolio and manage your exposure. And it can also help you to optimize your risk-reward ratio. So, for example, oil is closely positively correlated with the Canadian dollar and the Australian dollar. So if the price of oil goes up, for example, then these currencies generally tend to go up too. Whereas gold and the USD are generally negatively correlated. Gold is very much a safe haven asset. And so if you see the dollar, weakening, you'll find a lot of people will be putting money into gold.
And another way to ensure your flexibility in trading is being able to, something you touched on just now, is being able to respond quickly to breakouts. So breakouts are when prices suddenly move beyond established levels. So outside of, short, medium-term support and resistance levels. And these present real big opportunities for gain. But there's also potential risk there. But if you can identify and respond to these situations quickly, then you will stand to benefit quite well. So you need to be quite proactive here. Your technical analysis needs to be good, and you need to be vigilant as well. You need to look out for these breakout patterns. So if you can reactly to when the market shifts, if you can react quickly to when the market shifts, you can capitalize on these breakouts, and then you can adjust your positions to match.
Yeah, exactly. But that requires also sort of watching the charts and being ready and just, being well prepared. Yeah. And again, managing your risk in those scenarios. Yeah. And, that brings us on to our next point. You want to use stop loss orders. But by setting these stop loss orders, you have a predefined exit point, and you can protect your trades from significant losses during volatile market conditions, like you were talking about earlier, Chris. And this risk management adds a layer of protection, and it allows you to really focus on adapting your strategies to market movements, knowing that your potential downsides are limited. And I think this is a very important point. That, and also, if you're just starting out, limit your trade size. Stop losses and limit trade sizes until you get a real feel for the markets are absolutely imperative.
Yeah, and if you've got a lower trade size, that gives you inherent flexibility. It means you're protecting some of your capital. Exactly. You're protecting most of your capital. Yeah, keep your volumes low.
Yeah.
Yes, well, I think that's a good place to take a break. When we get back, we're going to talk about how to build flexibility strategies into your Forex trade.
Hey guys, hope you're enjoying the episode. If you're looking for more trading education, visit our website or FX Scout's YouTube channel. We have plenty of resources available. And if you're looking for a good Forex broker, go and check out our broker reviews on fxscouts.com.
Yeah, we provide an in-depth analysis of each broker, highlighting both their pros and cons. And you can always write to us as well. We're happy to answer any questions. You can get to us at podcast@fxscouts.com. And now let's get back to the episode. And we're back. So let's have a chat about, we've touched on some of these a little bit, but let's dig a little bit deeper into some strategies that can capitalize on flexibility when you're trading. So the first thing you've got to know is pattern recognition. So, this is technical analysis. It involves being able to identify recurring patterns in price charts. And I know it's something that you do a lot of YouTube videos on, Alison.
Yeah.
So Alison produces a lot of great YouTube videos on various chart patterns. So these things such as a head and shoulders pattern, triangles, double tops, double bottoms. And when you recognize that these patterns can really give you a good insight to potential future price movements. and it allows you to adjust your strategy accordingly. So in this approach, the great thing about it is very visual. And once you know how to spot them, you'll find that you can spot them over and over again. Yeah. And it really aids in your short-term decision making and in the longer-term trend identification as well.
Yeah, I mean that in combination with what we were speaking about earlier, the multi-time frame analysis, I think is a very powerful way of being able to speculate. Yeah. And another very powerful strategy is the pivot point strategy. We've just actually released a video last week on pivot points. And it adds flexibility by incorporating key support and resistance levels into your trading decisions. So they're calculated based on the previous day's high, low, and close prices. And it really helps you adapt your strategy to identify potential reversal or breakout levels. And this approach really allows for quick adjustments to, as we're saying, the changing market dynamics. And it really makes it a valuable tool for both short-term and then longer-term traders. I find pivot points are very useful. They're very useful for gauging market sentiments and also adjusting your trading approaches accordingly.
Yeah, no, they are a fantastic tool. Really highly recommended that people go watch that video. We'll put a link to it in the show notes. Yeah, and finally, something we've touched on a few times here is diversification. Flexibility means you can extend beyond one or two currencies. So what you want to do is you want to monitor different currency pairs or asset classes as well. So across the whole CFD spectrum, and you can do this based on their performance and other economic indicators. So, I mean, it's something I think we talked about a few weeks ago. We talked about some great trading tools that will help you with this. So, Auto Chartist is fantastic at helping you diversify your trading across asset classes. Trading Central as well. Yeah, don't be afraid to branch out. Don't just stay stuck on the Euro USD or whatever, or there's some major currency pairs. Have a look around. It's because, traders that diversify their portfolios, it allows you to really adapt to changing market conditions. A lot easier, a lot better, because you can shift your focus to those assets that are showing that there's real trend growth. The ones that are showing strength and allowing, the ones that have got a much higher potential for favorable returns.
Yeah.
And also, if you diversify properly, you're really going to manage your risk as well.
Yeah.
You'll find that your risk levels will be much lower.
Yeah. Yeah, I mean, it was something we were speaking about with Tom Salmon a few weeks ago. And he was saying, during the period where there was such low volatility and traders were, looking at other assets, that they found equities and indices, traders were looking at equities and indices trading. And they did a very good job as a company at adapting to that low volatility and supporting traders with those various instruments.
Yeah, with the pivot to equities. Yeah, exactly. Yeah, because equities at the beginning of the year were booming. It's a fantastic time to switch. So yeah, exactly. You highlight right there, Alison, the importance of diversification.
Yeah, I think that about covers it, Chris.
Yeah, I think it does.
Yeah,
I think it does this week. Fantastic. Well, thanks so much for your time, Alison.
Yeah, you too, Chris. And I hope it's a sunny weekend.
Yeah, better clear up. I want to get out. I want to go outside.
Yeah, enjoy.
Yeah. You too, Alison. Speak soon.
Cheers.
Bye.